And here we are. There we go. I remember how to do this, I think. Maybe. Um, Let me get things settled in. Do. Hope everybody's doing well. Been a long time. Alrighty. Um, let's see. Anybody here? Nope, no one's here. Just me, myself, and I. Alrighty. Anyways, let's double check. Yep, cool. Alrighty, happy April Fool's Day, everyone. Markets are still open here in the US. But yeah. Oh, hi Lincoln. You're here. That's cool. Uh yeah, the acquisition news is something to process for sure. Um so anyways, this live stream, hopefully people choose to watch the VOD whenever. Um it's about Finance 101 content. And these are the segments that I'm going to be talking about will be multiple chapters, multiple days um, of classes, all condensed into one live stream because I am dumb like that. So if you have done your Finance 101, I fully anticipate to get blasted and laughed at. If not, hopefully this is of some use. So we'll start things off with good old Cap M. Uh, Maybe it would be better if I shifted there. Yeah, yeah, like the description and everything is right there, so you can see what we're talking about. Um, so Cap M. Uh, Nothing really that crazy. If we use our or my cringeworthy uh, MS Paint uh, quote unquote artwork here, not to scale. Uh, if you know linear algebra, then you can basically work with kappa. Um, all you need for your inputs instead of y equals ax plus b, we have expected return for our y-axis, have our risk-free rate, um, which would be on that intercept. And I apologize for whatever reason my friggin' freezer's ice making is like stuck, so that probably will be there. Gotta love scuff. Anyways, risk free rate is right there. We also have beta plus the what basically is the what is the equity risk premium. Equity risk premium simplified is just the expected market return subtracted by risk free rate. Um, so you know if you recall basic linear algebra, we have here, here, or there, like Lamau. And, we could see, the orange line here would signify your risk-free rate. Um, the S&P 500 essentially beta of 1. So, you draw a line, voila, we have our market rate of return with the beta. And if risk-free rate, if that should ever change, then you go up or down based off of the rate. Not a very very difficult concept. And again, I didn't do things to scale because budget cuts. I joke, I joke. I don't have a budget for this. Anyways, so what I figured I'd do is like try and show the CAPM in academic terms and more or less like like this is not the risk-free rate, but let's just assume 2.5% is the risk-free rate. Let's just assume that we have three stonks, three publicly traded companies, and we have our betas here. Let's assume that market rate of return is 10%. Isn't always, but again, we're just doing this the way how a 101 class would be, more or less. Um, and we're going to assume an equity risk premium. If we recall our equity risk premium, it's both this less this. So, it's nice and fixed across the board because market rate, risk-free rates, risk-free rate. Like, we're not changing. The only thing that changes here, obviously, is beta. Um, and, we get our expected return profiles. Um, so, that's cool. I will revisit this part later on because, it's going to build on to future topics. But, by itself, we have, risk-free or our expected return profiles. And, the only thing obviously that seems to change is beta. Assuming all else is equal, that will be one of the biggest components of change. But I ask myself, hopefully any of us can ask ourselves what goes into each of these variables. Risk-free rate, generally speaking, people would say, T-bills. Some people would be like, use the 10-year rate. Dur, dur, dur. I'm not here to tell you what to do. You know, hopefully you can think through things, figure it out. Beta though is one that I want to do. I want to spend more time on though, because beta, like in previous live streams, talked about how the word risk in the academic or more professional finance sense uh, doesn't always mean the same thing as like risk that everyday people would think about. Uh, so with that in mind, beta would be some sort of standard deviation, and bigger beta, more dispersion of results, and like if we think of like a normal distribution, um, higher beta, more more big, not more big, but like things get wider, and with the wider distribution, uh, then wider results, which is why your expected return is the way it is. Lower beta for stonk A, lower expected return. But again, with that finance concept in mind, uh, lower quote unquote risk. So, if a person were to take a look around at different industries or sectors, stuff like utilities, utility companies tend to have, lower betas, whereas, your cooler tech companies, on average, tend to have higher betas. Um, and it kind of relatively makes sense. Like, if we're talking, conceptually here, your older utility companies are less likely to face things like challenges from other other peers or competitors in theory, because they're already there, it's already established. Whereas tech, when it comes to really cool software, you you're more inclined to either see really cool margins or competitors that see a metaphorical growing pie. Um, and that's quite enticing to other players to get into that space. um, so like there's a framework, but at the same time though, I think there is valid criticism with beta, because if we're talking about beta, which we are, we're talking about something that actually is backwards looking. um, Beta is a trailing thing. Now, I mean, like in the context of this equation. Now, could you be a cool professional with lots of smart people working on this and improve? Like have some sort of rough idea for forward beta? Maybe. Should you include that into this basic model or improve upon this model or equation? Maybe. Um, but that I leave up to you. And again, I know that finance is a broad place. So, any place that's broad, you're going to have, all sorts of different thoughts and ideas. And one of the cool things is I know some people are statistically or quant minded, and, they could, in theory, do something really cool. um, and improve upon such formulas. And I could go more into CAPM, but what I figured I'd do is also like hint at potential stuff that like you'd use CAPM for. You could do things like expected payoffs. Supposing like you have a probability setup of a bearish environment for stonks, relatively steady, or quite bullish. Have some sort of probability weighting for those things, and try and attach expected return profile with that, and voila. You could also, and it's already been done before. This is very very well trodden ground. Um, apply uh, apply weightings to a portfolio. So supposing this was a super concentrated three stonk portfolio, you could play around with the weightings and see what sort of return profile things would be with this. Now that's outside the purview of this entire live stream. Maybe I can revisit this and do it if there's enough interest. But for now, I figure at least get the framework for CAPM to talk about the next thing. So gonna quote unquote pause here and see if there are any comments. Oh, why hello Dex. Hello Dex. Good seeing you. And even Andrew and a Norman Steinmetz. Assuming I'm pronouncing that correctly, because I am sleep deprived. I don't trust me with very much right now. um, so let me edit the crawling ticker thing, and we'll move on to the wacky whack, the world of whack. Alrighty, so let me just set this to the side here. The heck is whack? Um, anybody can obviously Google or use AI to explain things, but oversimplified, and I'll try and break things down. We have weighted average cost of capital. That's the fancy acronym. uh, and you have three components. A lot of online sources will be like, "Oh, cost of preferred stock. We don't need that. Get that out of here." But in this case, for completionist sake, I'll mention it. Cost of equity. So for the EV component, we would use shares outstanding times RE, and if we recall RE, oh look at that cost of equity based off of CAPM. It's like I structured this. It's like I banged my head against the wall and really tried. uh, times that plus the cost of preferred stock. Cost of preferred stock broken down with the weighting of the preferred stock and the value. So like how would you get the value of a preferred stock? Well, fundamentally, with the preferred stock, we're looking at it's something that's done in perpetuity. You have a dividend, you have a share price. So you take dividend divided by share price, and you multiply the weight. Congratulations, you got your cost of preferred stock. Let me just edit this just for memes. I forgot to have that set there. Dividend. And then you have cost of debt. Cost of debt has a tax component to it. So again, you would weight things, debt to some sort of market cap, or maybe you're really cool and you really like enterprise value, make adjustments where needed, blah 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 blah. But yeah, you have your debt. But after the debt, if you want to be complete, well, should be a completionist in this case because it is a formula. You'd have one minus your tax rate to show that when it comes to any sort of cost of debt component, there is a tax benefit or an efficiency of sorts. So All this to say, voila, I have a supposition here. Let us imagine we have a company. We have a current WAC of 7.74%. Our weightings are no preferred shares. But at the same time, if we really wanted to, we could change the weightings around, be like, oh, debt is 20%, private or preferred stock is 10%, equity is still 70, if we really wanted to. Um, that would definitely change the current WAC profile, obviously. But again, this is like a 101 style class with me being the guy who's trying his best here. Before our cost of debt, 6% tax rate of 30%. We imagine that our existing beta, or maybe we're a publicly traded company, and we see that we have an existing beta of zero point 0.9. And what's based off of CAPM and other things, we can see expected market rate of return 10% with a risk-free rate of 2.5%. Now, this is where the academics try and, or a class hopefully tries to somewhat mirror real life. Let's assume that we want to do a project. We're convinced that the project's going to be great, but with any project comes risk. Um, so to try and show that risk, our beta increases from zero point 0.9 to 1.2. We'll make the modest assumption that risk-free rate doesn't change in this time period, but yeah, and also the tax rate. But the bigger one is cost of debt. We're making a very big assumption that our cost of debt will be the same. Now, in most realistic cases, this is almost certainly silly because if you're going to take on a project, either you were sitting on a fair amount of retained earnings in the form of previous cash, or more likely you're going to use debt to finance. In which case, we're doing that. But for the sake of argument, we're just assuming none of that pesky stuff is happening. None of that pesky reality is happening in this here quote unquote class. Uh, we're gonna go with our current WAC. We have our weights, assuming our weights don't change, just the beta. We have a new CAPM of oh shoot, this should be 0. Derp. I was just fiddling around just to see if I was any good at this still. And we have our tax rate, or rather cost of debt, uh, and with our new CAPM, no shoot, yeah, there we go, new CAPM. Um, Hold on, where did I go with this? I forgot. I'm drawing a blank. I am sleep deprived. uh, oh yeah. That's right. That's right. Um, again, basic formula. Plug it in, play, um, and we have our new WAC, cost of equity. Our cost of equity has been updated with us taking on a project. Preferred share hasn't changed. Um, Debt profile hasn't changed. So we have new WAC. Did I screw this up? I feel like I did. Because let me double check something here real quick. Ugh, hold on. Gotta update the ticker. Probably messed up. Oh, hooray. I did great. Whack is whack, yes. Oh, why Hat is here. Hello, Hat. Hat, hello. Um, do. Beep, 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 oh. What. Doobity, beep, oh, bo. Beep, beep, oh. Amateur streamer, amateur hours. Do 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 do. Mm, mm, dudes. Fuck. Ba, 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 ba. Turns out the only fool on April Fools is me. You'll love to see it. Shoot. Did I? Did I do this right? Thought I did. Thought I did. This is annoying. This is frustrating. Mm, mm, mm. Screw it. Um. Yeah. Yeah. Screw it. The point of of whack is decision making. Well, all right. 2 points of whack. Even though some people don't like betas, you could use free source such as the Motorin. He's actually modified models, or rather, equations in this case, where you could use something else besides betas. Uh, what's nice about WAC is it's a way to think about a management team or an executive team's ability to manage capital and capital structure. For example, maybe you as the investor want to think more like an operator, and you don't necessarily want to like dilute shareholders fundamentally. Um, when maybe debt is a better choice. Likewise, maybe you have to dilute shareholders, but the project in question is legitimately very worth it. So, if the case is we have a project idea, we've thought through this, planned it out very well. How do we fund it? And what do we do to fund it? Maybe it's a combination of all of the above. And this is a way to do it. See the outcomes of a before and after. Um, but we live in a world, we live in a society that that the um, that we're it's not only just whack. So suppose if we wanted to just use whack upon whack, suppose the project returns are lower than if the potential whack is lower than the current. Do you take the project? No, probably not. Shouldn't. But we have other tools such as internal rate of return (IRR) or net present value (NPV), which we will get to in the future. But if the IRR is greater than the WACC, in theory, you do it. If the NPV is bigger than the WACC, or rather, if NPV using WACC is greater than zero, in theory, you do it. Um, And again, that'll be revisited in the future. But for now, just wanted to talk about how, again, we're using literal like linear algebra and you know putting it in here. So in the case of simplicity, this one I'm very confident I didn't screw this one up. Aha. Let me double check on some things. Yeah. Let's hide that. Edit that into, well, not hide that, but edit the ticker or crawling thing here. Discounted payback. Bloop. Check the comments. Oh, Boo Hat is getting food and ready to learn. That is cool. Um, Wonderful. Okay, so here we go. Do. Discounted payback. Um, if we wanted to do a project as a business owner and operator, um, maybe we're not publicly traded. Maybe we're pretty darn small. Let's suppose we run, I don't know, maybe like a gym or a massage parlor of some sort of good repute. Suppose, I don't know, there's some sort of like automatic massage chair machine thing that will cost us $10,000 US, and we're simple folk. We're small business owner, so we just don't want fancy stuff. We just want to be paid back or make our money back in 2 years. Uh, and you as a business owner operator have a choice. Maybe you think you could invest the money into I don't know, some sort of like tax efficient fund. So you have a 10% rate. Like the massage chair must generate cash flows greater than 10%. So you set the floor, you set a discount rate. Um, so how do we plan this out and figure out if we get our money back within 2 years? Uh, Pretty darn simple. Just literally plot things out with a basic timeline. We'll imagine that first year or year zero right now, cough up 10K. First year annualized cash flow will be $4,000, 4,500. Somehow year three has a banger of a year. I don't know, like maybe our really amazing sales rep is really really hurt, and we'll be back in 3 years time, roughly, somehow. So we got 10K there and $8,000 there. Well, we need to discount the cash flows because cash flows in the future, basic principle of finance, are worth less than the cash right now. If you didn't want it to be discount payback, if you just wanted simple payback, no discount, you just take this, plop it in here, and you adjust accordingly. Where you would uh, you know put it into the total cash flows. Take the startup capital that was committed, starting cash, and reduce the amount until you see break even. Uh, Problem is with math and numbers in this case, you don't see a quote unquote zero. So break even doko. Where is the break even? Um, I highlighted these two parts right here for simplicity because we know somewhere in year three or year two, three, we get our break even. Uh, so, well, rather year three. So, you know, divide, very, very simple. Um, Hopefully I can view, do, show formulas. You know, it's not a complicated thing. Because this is a negative numerator, just adjust it, make it positive, and we can obviously see it's a bit over 1/3. add it to year three where it is. So a little over 3 and 1/3 years, we have break even. So in theory, if we refer back to our original scenario, you as a business owner want to get paid back in 2 years, you don't take the project because you're not getting paid back within 2 years. Now, things change. Maybe the positive cash inflows are improper here. Um, so changes the entire thing. But you know, it is what it is. I like to think that this is pretty simple. Don't need to be a publicly traded company. This is as pretty darn simple as it gets. The only way it could be more simple is no discount rate at all, which I would argue is probably silly. Um, Let me double check. Hello, EJ and James. Oh, no, 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 no. This is a purely hypothetical massage parlor thing. So no one is banned um, from that, at least. Alrighty. Let me update the crawling ticker. Now playing NPV. Yeah, I'll show that one. There you go, Dex. Peepo coffee. NPV. See, we're trying to think like operators here, operators of a business. Um, an ambitious thing for a nearsighted, past-looking, wannabe accountant here. All right, NPV. What are the strengths of NPV? It's great for independent and mutually exclusive projects. How do when all is said and done, when you look at NPV, what do you do with it? Well, it's relatively simple. If it's bigger than zero, like Lamau, do it. Okay, not as simple as that. Like other considerations, but if it is makes sense, then it's not a bad decision. And like I originally referenced, mutually exclusive projects, in theory, bigger MPV of the two projects or more projects that you're looking at, do the bigger blah, 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 net present value. There we go. So for MPV, it can be a rather long and extensive formula where you have the startup upfront cash costs. So year zero, set at year zero. We're using the same reference of you own and operate a gym massage parlor thing. Uh, geez, hold on, sneeze. I forgot how to StreamYard. Okay. Yeah. Plus, cash flows from year one, modified with with appropriate discount rate. So 1+ discount rate. Enclose that, and uh, you have your exponent set to what respective year it is. And you keep doing that all the way over. Blah 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 blah. Um. So our in this case, our end total cash flows using NPV is right here. Net yourself in theory, 10K into the future. Number far bigger than zero. So in theory, you do it. Um, Sorry, gonna have to blow my nose. It like randomly got cold where I'm at, so it's struggle bus here. Okay, hopefully the delays some things in the future. Um, Anyways, yeah. Now, because technology is is such where I don't have to manually input things, you could just Lamau function it. Let me show the formula. Like, it's not a hard thing at all. Like, you can literally Google how to do this on Excel or on what's it called? Google Sheets here, obviously. Um, hashtag not sponsored. Uh, but it's structured very, very simply. You know, like you have your inputs of what discount rate you're using, right? Yeah. You have your inputs for your cash flows, yeah, and you also take into consideration your cash flow, your startup costs rather, for the project. Pretty simple and pretty neato. Um, but in this case, the fun thing is that like NPV, it like I'm breezing through the presentation here, but talking about this thing, it's simple. It's simple, but like it takes time and it can be tedious because again we have a massive jump in cash here, and even like the simple boring ones. Um, the we're talking about in the future. Like I think it is very, very understandable and quite reasonable for an everyday person to be like, oh, you're a fortune teller. Oh, do you have a glass ball? Do you read the tea leaves? Um, but we do the best we got. Um, and the cool thing with NPV is, yeah, maybe it takes longer than discount payback, uh, but at least it like captures the whole picture. Because discount payback, you're pretty ruthless. You have a extreme cutoff, and your cutoff is there. You don't care necessarily about future cash flows beyond that time frame, and maybe that unfairly punishes certain projects that should otherwise get the attention it deserves or more due consideration. um, Spoiler alert: when it comes to fancy publications that try and pull either executives or management teams of some sort or another, like what sort of modeling they do or budgeting or methodology, it's usually like a combination of two or more things. So, like in the case of, say, for example, going back to WAC, cost of equity, like, maybe you have a cost of equity that is based off of WAC or not WAC itself, duh. Uh, WAC based off of WAC, no. WAC based off of like CAPM. Maybe you use CAPM and some other model and you take like an average of that and other like methods or models or what have you. So again, this isn't like me saying, oh, 101 is great, it's going to fix everything. Like, no, that's not how the world works. World is quite more complex and refined than just the basics, but not to crap all over the basics either. They have their time and place, and they have their own merits as well. It's trade-offs all the way down. So let me get back to uh, some editing of the ticker here. Blue, 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 IRR. Oh crap! Hold on. You're on, Fabio. You are on.
Well, hello.
How is vacation, Fabio?
Not stressful.
Not stressful. Very nice.
Mm-mm.
Enjoying yourself some whiskey.
Yeah. What are we discussing now?
I am discussing IRR, good sir. Yeah, I just got done with MPV.
What's next on the chopping block?
What do you mean, like actual stonks or this entire live?
This entire life.
Yeah. So what I got is IRR, and then blah, 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 blah. Gonna like nitpick and compare and contrast IRR and NPV. Like this
Okay.
is as basic as it gets.
All right, so let's get into it. So what are the differences between IRR and MPV? I remember it back from school.
Mhm.
Let's get into it. The academic side.
Alrighty, so you recall the NPV formula? How the equation is basically this but prettier.
Correct.
We
Yeah.
have our startup cash, and then sum up the reduced cash flow or discount cash flows in the future.
Yep.
Well, IRR is like, hey, NPV's neat. Let's set NPV to 0, but still have all of this, and instead we have the some sort of discount rate used as a hurdle rate. If it is greater than 0, then let's go for it. IRR, of course, is expressed as a percentage, whereas NPV is expressed as dollar.
Which gives it what weakness?
That's in the future, good sir. You were
Oh,
getting
okay.
ahead. Oh.
I'm getting ahead.
But yeah. Let's see here. What guy joining? Yeah, it's Fabio, Professor Fabio. In fact, how does it feel being a professor on vacation in
I
the middle of
wish.
spring semester?
If I was a tenured professor. Yeah, I wish.
So yeah, we're using a corny example of what's it called? You're a gym or a massage parlor owner, so startup costs of a possible automatic massaging chair thing is 10K. We have our cash flows. We have our discount rate of 10%. Obviously, I just was at this point, relatively lazy and was like, hey, IRR function. So, for everybody that watches, voila, basic IRR function.
Yep.
I could have done better with this and just set that to the cell, but whatever. Screw it. We got our output, and it's simple, basic. IRR also says new project. Now,
Oh, you already have it right there. Yeah, I already.
yeah,
Yeah.
yep. So I'm gonna update the calling thing here. NPV and IRR. Let's
So what
go.
do you mean by, for the audience, what do you mean by hurdle rate? So,
The hurdle rate would be, if your IRR is lower than what it should be, then don't
yep.
do the project. Now, to get back to what you were originally asking, what are the problems with IRR compared to NPV? Well, we have a scaling problem. Let's bump up some numbers here. Let's suppose we're a bigger company. Let's suppose we are thinking about 2 projects. We
Yeah.
have a arbitrary discount rate of 8% set here, and we have our respective cash flows. 2 projects. Project 1 costs 1 mil upfront. Project 2 costs 15 million upfront. Cash flows for project 1 are relatively smoother, of 200K for year 1, 400K year 2, 300K. 500K for year 3. Year 4 has 200K, which will produce us NPV, as the audience can see, about 72K, IRR of just under 11.1%. Project 2 startup cash is startup costs much bigger, 15 mil, but the cash flows are not as cool. Rather it's bigger, and we have more wonkiness here. So 2.5 mil for year 1, 5.25 mil year 2, year 3 has 6 mil, year 4 somehow has 4 mil. Just we'll go with it. NPV quite bigger on project 2, but the IRR, because of the scaling issue, has an output of less than 11%. Actually, less than 10.6%. So people can double check my formulas, make sure I have things right, as opposed to me screwing up on the whack. Um, you know, so it's a problem. Like which project would you go for? Assuming all else being equal, assuming constraints are perfectly fine. Um, you know, that's I'll leave that one for the audience to decide. But if I'm being asked what to do, I would say go towards NPV. NPV better. What say you, Fabio?
I'd say you should use them together, but yeah, IRR doesn't give you the scale.
Yep.
So it doesn't give you the scale context. So if you only give me the IRR of a project and you don't give me, the nominal value, the nominal notional value, like NPV, or express an NPV, I don't know what to do with that. Because, like, what if it's a 50% IRR project and it's like a, say for your scale thing that you're using here, it's like a $10,000 project.
Yep.
Like, oh, that's great, we're getting 50%, but 10,000 is it worth our time?
Hmm.
Maybe, maybe not. Of course, in a perfect world, if we have no capital constraints, we pursue every project that has a positive IRR. But we don't live in a world where we have just like infinite capital to deploy. So yeah, I'd say use both. But if you only had to give me one, I'll take MPV.
Wonderful. There also is another problem that my little explanation here doesn't have. That would be, any sort of project, like, no duh, cash flows can be really, really lumpy. So IRR does not play nicely when cash flows uh, go positive to negative to back to positive. Like things have a tendency to break.
Yeah,
Yeah. So NPV, like more effort is put into it, but
yeah.
I think it's definitely worth it. Um, so all the academic stuff to say, um, when it comes to the world of CAPM, WAC, discount payback, IRR, and NPV. I think that it gives people enough tools to try and work around and think a little bit more like operators. So that way you could, like with whack, again, you have current whack, but supposing they want to either pay down debt or buy back shares, what does the whack look like in the future going forward with whatever decision making they choose to do. um, it's a way to try and gauge a management team on that. I don't know what would you say to those thoughts for the everyday person.
Yeah, I mean, we always want to pay attention to our WACC because, in effect, that's kind of our internal hurdle rate.
Hmm.
So it's like what our weighted average cost of our capital is. And so if we're earning returns under weighted average cost of capital, we're wasting our time. So in depending on how our capital stack looks like, it's going to cause maybe things to look a little different as far as the cost goes. So every incremental, pile of debt that we take on might get more and more and more expensive. So that could pose a problem for projects we're looking to pursue in the future. It might constrain us further, and that's intuitive. Like we think of companies right now, it's like think of the most indebted company you know of. Can they take on double the amount of debt now, and go do whatever projects they can, or is that incremental debt that they're taking on? If they were to take on um, another 20%. Is that going to cost more than the debt from before because the market's going to perceive a greater risk, et cetera? All of those things have to be answered. So there will be times when a company has to look at their debt pile and say, well, if we don't pay down this debt, our WACC in the future, yes, will probably go up. We might be perceived by the market to be a greater risk, but we want to pay down that down so we get, or we sustain a lower cost of capital. So it might not be to lower it, but might be to sustain as well. So yeah, it all comes down to that decision. But we often see companies wanting to pay down debt when that's not an issue, and the equity component is going to be always more costly because, like, if you make a judgment call, it's like equity will tend to be always more costly, especially if you think about it as the present value of all future cash flows that are unknown. And so usually when you see modeling, people don't go really beyond 10 years because we just don't know, and you usually see like a big step off in the projections. But technically that is not true. So like, let's say if you model something out and you say, I'm making up numbers here, but it's like 10% every year for 10 years. And then after year 10, you usually do some sort of like drop off, either the terminal rate or the exit multiple. But if you do the terminal rate, usually people go down to like 1% or 2%. So obviously that might not happen, right? And so it's like the equity could continue to grow, or not the equity, but the business could continue to grow at a 10% clip after that. And so you can try that out and plug it in. And like, let's say assume a terminal 10%, the number is going to be vastly different. So that all to be said, is technically when you see that, assuming the actual years predicted are correct, the terminal growth rate is usually more conservative. So, coming back to the point, equity tends to be always the most expensive portion of debt. And some people have different ways of kind of valuing the cost of equity. But different companies have different philosophies on it. Like Constellation Software, which I don't know if you've covered on Two Accounts, One Gap, but Mark Leonard has a belief that equity is by far and away the most expensive form of capital and should never be used. It's too expensive, unless you don't believe in your own stock. I think have at it, But debt if possible, and if not debt, nothing at all. So, yeah.
I do have another thing, a random fun question that I don't think I've ever asked you. There are some people that would say, "Oh, stonk picker, you're only doing good because you're levered beta." And thankfully, my crude illustration showed that when it comes to like CAPM approach, all we're talking about is like a linear regression. What say you to people that would be like, "Oh, stonk picker, you're just levered beta. Congratulations, you did good." But you didn't need to agonize over fundamentals or what have you.
I mean, yes and no, because that does ignore the individual stock rates that you have to avoid. But if you're just looking at broad kind of factors or indices, yes, and that's assuming that you're going to have if you're levered beta, right, you're going to assume that you're going to have a generally upward trending market, because there are markets where it's can be downward trending or flat for a while, and if you're levered beta. But if you're a stock picker, it's more than just being levered beta. It's avoiding, individualized risk that you don't get with the broader index. So true levered beta is just a levered ETF, right? So that's true levered beta.
Yeah, because like when I heard quote, "You're just levered beta," I like kind of wonder, what do they mean? And if it is just capital efficient ETF or fund or some structure, then cool, I'm out of my league. But I think like if you do care about fundamentals, and if fundamentals truly do matter, then we're talking different risks and different considerations.
Yeah, and a snack foods company is not the same as a financial company.
Oh yeah, and the flows and the market participants also matter in that one. Let me get to some live comments here. Fuhat asks you to show a pink bird, a flamingo. Dex
Okay.
notes that you are partying hard. Jake also asks for his admin back.
He has to promise me never to at a large group of people ever again.
He did say that he'll be leaving Sunday if he doesn't have the admin back. So make of that what you will.
If he promises me to never at that many people again, then I will gladly give him his admin back.
Okay. He says to tell you that he's sorry, and he admits that he did take it too far.
Okay, I forgive you, Jake. I will give you your admin back.
So I guess we've reached the part of the presentation where, surprisingly, I blazed through multiple classes and chapters all in one. Fabio at gold twice. He should remove his admin.
I already did. I took a vow of silence today.
Just I don't know. What are your thoughts while you're on vacation? Anything cool? Any profound thoughts hit you yet?
No, I'm just here and there, if I'm by myself, because right now I'm by myself. So
Hmm.
I listen to updates on, what's going on with tariffs. I just listened to the EU spokeswoman speech. So she gives some interesting tidbits on just like their view of things, but there's a lot of noise, I think, and I think it's going to turn out to be a lot of noise. So we'll see. Well, if we can get into details if you want, rather than keeping it big of like, oh, it's just noise, but it's a big topic, so.
Oh, it certainly is. It's even though I've like tried to limit my news inflow, I can't deny that it's a macro topic that really moves the needle.
Well, it's moving the needle emotionally,
Oh, for
but
sure, right now, but
yeah, I'm not sure it changes anything fundamentally.
Fuhat is asking about if you caught any fish. I think you said you caught a tuna in
I did
text.
catch a tuna.
Yep. So there you go, Fuhat. Huh.
Yep.
Oh, here's one. Now that we've had a full day to digest, and someone did mention it earlier in the live, Mr. Cooper, that acquisition, eh?
Kind of upset about it, but it is what it is. So, because I think Mr. Cooper by itself would have eventually hit over $200 a share, but being part of Rocket, it's now going to be tied to what you think rates are going to do and what you think origination volumes are going to be, which is something I have to think about because I'm not entirely sure if I'm 100% comfortable with it, but I see it could work out.
Mm-hmm.
So it was like when I first pitched Mr. Cooper, it took a long time to get people to understand it was a service-based business. It wasn't an originations-based business, and so rightfully so, you had a lot of questions and concerns about the leaning on an originations-based business because it's going to be more timing. And every time we were like, it's servicing, but that doesn't necessarily matter for this company. Well, now that's no longer the case because since it's tied to Rocket is going to be very tied to the originations volume. So now those concerns that some people had before, those are 100% valid now. And Mr. Cooper is should no longer, I can't justify it, be looked at as a servicing-based business. The interesting part is if it does start to fall, you could actually make an argument to get back into Mr. Cooper because it puts the deal at risk or will make Rocket up the offering. So let's say Rocket falls because the market shows continued weakness, etc., blah, blah, blah. this increases the likelihood that Rocket will have to come back to the table and offer even more for Mr. Cooper, which I think that would be a fine outcome. That would be a great outcome for Mr. Cooper shareholders, because I think also what they paid was too little. I think for Mr. Cooper, in my view, the multiple should be, if I wanted to assign a fair multiple to a service-based business, would be about minimum on the 12 to 15 times earnings is where I consider fair, which would again imply Rocket. For Rocket, it's a great deal. So good on them, because they're getting a fantastic asset and they're paying it in their shares, which, in my view, their shares are not as cheap, because even though the multiple was similar, Rocket is an originator. It's not a servicer. Well, it is a servicer, but it's mostly origination. So you can't give it the same sort of value. But together, these companies probably are going to be really good. If Rocket actually manages to unify this and tie a bow on it neatly, this will be my dream company in the real estate space, where I wished Zillow would go to, because they will have everything. They will have a very good service stack, a very good origination stack, a very good sales pipeline stack, Redfin, etc. And so they can service everything from the transaction of a home, which what I think Zillow got into was the innovator's dilemma of not wanting to harm Premier Agent, which Premier Agent is where the majority of their earnings comes from. And so I thought Zillow had the greatest potential of getting to this point, but it looks like Rocket is going to be the one that gets there, unfortunately for Zillow. So, and Mr. Cooper, CEO, he's now going to be moving to head of the mortgage within Rocket. So basically exactly where he's at now, just at a larger scale. And Rocket is able to achieve a higher conversion rate than Mr. Cooper. So if you take Rocket's conversion rate and then do some simple math of maybe not 100% the same, but even just like meeting halfway, that would still imply a great degree of efficiencies earned, and could lead to higher EPS growth in the future for the combined entity. I believe Rocket boasts close to 80%, around 80% conversion rate, while Mr. Cooper is quite a bit lower in the 50-60% range. So any improvement there would be very welcome. I think if you hold Mr. Cooper, maybe you make the argument to just stick it through, because you have a great asset, falls through, you keep a great asset. If you sold already like I did, because I'm on vacation, I wanted to sit and wait. If it falls back, I think it's a great time. That would be a great time to re-add. Again, for the same reason, falls through, you have a great asset, goes through. Again, if it falls, I think that they'll probably come back to the renegotiation table and offer you even more, so you'll get out a little bit better. So that's especially why I think if it does fall, buy. Like if it falls to back to like just over 105, around there, anywhere around there, I think I'd be buying quite a bit of it. Oh my gosh, the market just closed and I got my notification. Johnson & Johnson is down 7%.
So much for safety. Got to be some sort of news.
The cow.
Dan says Newsmax is at 240 the share apparently.
Well, Dan, markets are efficient.
I will. Go on.
No, I was just saying, if he dares question that, I don't know what to tell him.
I wanted to ask though, like, as far as rough timelines with Rocket companies, assuming the mergers go through, or the acquisitions rather, what do you envision for a timeline to metabolize and see synergies, hopefully develop?
It shouldn't be more than a year, if I'm being honest, because they are, like, Rocket does have a servicing arm, Rocket has everything Mr. Cooper does. So you're just absorbing operations and then kind of getting the talent to sort of integrate. That's the hardest part. It's the talent side. But the tech stack that Mr. Cooper has, I think, is probably a bit better for managing the services. Rocket has a much better marketing team, much better sales team, so they get a lot more leads than the latter. And I think that for what Mr. Cooper's bringing to the table, they're not going to be that big of a deal. Redfin is something Rocket is not in at all. And so Redfin, I think, is the harder one. Cooper, I think, is easier. So Cooper, I'd give it like a year or less for there to start to be noticeable synergies. And then for Redfin, I'd probably put that at a question mark. I'd put a question mark around that one. I really don't know. That's the one you want to watch out for.
Alrighty. Apparently, I've been asked also to show Watton Financial Limited, ticker symbol WTF, which is funny because apparently
it's only because it's ticker.
Jumped up. Well, no, more so just because apparently it's jumped up massively. It
Who's
was
asked
Andrew
for
who
this?
said it. Yeah, Andrew. He said that it IPO'd today. So I guess maybe the IPO market's back. We're back, baby. Oh shoot, hold on. I'm not hearing anything. This is upsetting. I think I might have lost Fabio. Oh no, it's probably the internet connection. But yeah, I'm gonna have to.
I tried searching the ticker. I can't. I don't have enough internet to do two things at the same time.
Yeah, it's fine. I gotta try to zoom in. Apparently, it's had one hell of a day. Up massively. Do a better job zooming. Let me double check the stream. No, darn it! What the heck? I'm not sharing the right thing. Oh, Andrew's here. Oh wait, nope. Sorry. Hi, Andrew.
What's going on?
Not too much. I'll stop sharing. And
Dude,
where is Andrew?
My office.
There we go.
This is my office too. My new office.
I just was going to tell you. Do you see WTF IPO today? They're up 350%.
What do they do?
Go up. I don't know. We do the IPO. You have Newsmax up, 1,000% whatever, and you have this WTF, Watton Financial Limited. Yeah, they're up 400% today and 10% after hours. So just all you have to do, guys, IPO with a tiny float, and you'll rip. Because that's all this is you have these companies with tiny floats. But I'm trying to see what they do.
Andrew, everybody's happy that you're here. It's like you restored the side project. Side project restored, Andrew. Did you want to?
100% restored.
Did you want to share any? Did you want to share any info for the viewing public that may not know about developments?
I just want to see what this WTF company is. So okay, here's
yeah,
the price.
It's an interesting ticker.
Yeah. I mean, I would be surprised. So what was the last one that did that? There was another company. That was a Hong Kong company that ripped on their IPO. This happens. And for anyone asking, no, you are a special kind of stupid if you're trying to short these things right now. You're asking at your face with that. I like the music.
You can hear the music.
No, yeah, we've been hearing
music.
I, I had no idea.
It's the
Yeah,
British Virgin
yeah.
Islands Incorporated holding company that provides securities brokerage and financial technology services, primarily through its Hong Kong subsidiaries, Watton Securities International. Yeah, so they did 4.3 million shares as the float at $4 per share. So, I'm trying to see. So, I mean, I'm sure these guys were valued at something like, I don't know, not a lot, because they're raising like $20 million. And
20 million for an IPO.
Yeah,
20. That's a huge IPO.
Quick is 4.37 million shares at 4 per share.
Damn.
The bank IPOing is Cathay Securities Inc.
Great name. Great name.
So seems like legit. Remember how people say like this? One of the signs before at the top is insane IPOs. We might not be at the bottom
We
yet,
can't be at the top yet.
We might not be at the bottom though.
But we can't be at the top right now.
I love conflicting signals.
I mean, I know what you're saying, Fabio, but so what are you guys talking about, by the way?
Valuation stuff. And hey, look, it's Dan.
Now Dan's on.
So
You're doing
Is
okay,
that Dan's
Dan.
office?
I'm just in my office. This is the worst day.
I'm just gonna tell you right now, Dan, with your hoodie like that, there's that one guy who does videos, and when he like pretends to be a girl, doesn't like put a hoodie on, like in his skits.
I had to threaten a treasurer today. You'd be proud of me.
Oh, good. Treasurers are useless. Oh man, Fabio, that's a risky shot right there.
Yeah, don't he got frozen in the wrong place? Oh no! That's not where you want to get frozen.
Kiwi Sam is
Dude,
gonna have a
Kiwi
field day.
1000% is.
Kiwi's like, shut it down, there. You just about got
If I
frozen.
just
The
lower
worst
the
possible.
camera down here.
Did you guys see, by the way?
What'd you guys see?
Corey was up 40% today.
It froze like almost down all the way.
Kiwi Sam wants me to do it. Kiwi Sam wants me.
I've never used the phone app. I was trying to see what it looked like.
That's not bad. Not bad at all.
Did you see Corey up 40%?
Okay, it's okay.
I have not.
How much was it up?
40%.
32%.
We are so back.
Oh,
Market got killed yesterday. You missed it.
did it get killed yesterday?
It
started like
yeah,
it was like 1%, and then it rebounded a bit.
yeah. Oh, look who's here.
Oh no, you're done.
Yeah.
He's on you.
So,
Fabio, how did the field outperform us all sitting at a cabana? Were you happy?
That doesn't make everything else do well. That's just Mr. Cooper.
I messaged you in the morning. I'm like, Fabio, sell it before it opens. I couldn't get hold of you before it opened, but
Yeah,
because it got up pretty high, like 138.
I think right now it went up today like 5% or so, right?
Hey, Fabio.
4.5.
Do you know what ASPI? Remember that company?
Yeah.
Do you know what they announced today?
What?
They're doing quantum enrichment facilities.
Quantum enrichment?
Did they go
What is
up on
this?
that?
Were they up today? Let me see. Oh, they're up 2% today, or 3%, I guess.
I mean, so
They reported earnings, though. I should say losses. I think they burned 20 or 30 million.
it's a healthy amount.
Yeah.
No, we lost Dan. Thanks for stopping by, Dan.
All right, so Mr. Andrew, we already talked about Cooper. What are you doing with Cooper? What are you thinking about it?
In terms of holding or selling?
You already sold, but what if
I mean, Cooper's
you're looking at
I think rates go down.
Yeah, but if you think rates go down, don't you want to acquire Rocket?
But Cooper has a slight discount to its acquisition price.
So just buy back Cooper.
And I think it's Cope if we think that they're going to renegotiate the deal.
Yeah.
I think it's Cope.
Yeah, the only concern would be probably regulatory, and I don't think that's a very serious concern right now at this time, but I could be wrong.
Yeah.
I'm just curious to see what happens to tariffs tomorrow. I don't. Oh, I was able to find inventory for nanonuclear. So that.
Hey,
That's
found
the
an
only thing I've done.
Yeah, the only unfortunate thing is if I buy back Mr. Cooper, basically it was very tax inefficient.
Rocket? Yeah. Oh, in that case, you buy back Rocket. Or you buy Rocket for sure.
No, it'd be no. You don't. I mean, you don't buy the Rocket to spite Cooper. It's already too late. Like you recognize the tax, right? You can buy Cooper.
Oh, I'm stupid. I was thinking wash sale. Okay. Go ahead.
No, there's no wash sale.
Yeah.
Every single share was sold at a gain.
Yeah.
But if I wanted to play the rate idea, the best idea or the best move would have been to be just like, hold Cooper. Just roll with it.
Assuming that the synergies actually really manifest in a good way, how are we thinking? How long will it take for rocket companies to not be the meme rates trade?
It will be until the company really proves that it has a valid servicing business and everything else, and that's going to take a while to even integrate.
Yeah.
2027 is whenever you integrate it fully.
They already have a servicing business, but it's just not as meaningful as Cooper's was.
I looked at on it. I don't get why these guys have screwed up so bad compared to Mr. Cooper.
The management's just not as good. The management at Cooper is much better.
I know, but it's insane. These guys were bigger than Mr. Cooper 6-7 years ago in terms of revenue from servicing.
Well, that becomes always the risk with any of these companies. These kinds of companies, it's key man risk. It's like you have great management, great. It's bad management, bad. Just like banks. So, I've been thinking about it. It's like I don't know if I want to. I'm conflicted. I'll be honest, Andrew, on Rocket. I'm conflicted. I like it, but I don't know if I like it as much as Mr. Cooper. Because now it's a different game. Now it's rates. Genuinely, it's not. There's all this misunderstanding about what Mr. Cooper is, and it's a servicing business. Now it's like, you have to or shift away your thinking from Mr. Cooper from servicing to now being tied more to rates because it's tied up with Rocket.
So,
So our original thesis, it's up in the air.
yeah. I mean, the good thing is, the only thing I'll say about Rocket is this: they use stock to the acquisition. If you're bullish Rocket, it's a good thing. Trading a lot more expensive than Cooper already.
Yep.
I don't know what I think, but it's the best way to buy them in cash.
Yeah, it's a lot more expensive than Cooper, especially when you consider that the servicing business should probably have a higher multiple in the first place.
Do you guys know when tariffs are going to be announced?
Allegedly tomorrow.
Yeah, it's tomorrow.
It's
But
the
like,
big day.
you will announce them tomorrow, like in the morning.
That I'm not sure as far as the exact time.
I believe they take effect in the morning.
Where's your new early? Well, I gotta hop off because I got stuff. I'm at work, but if you're on later, I'll hop on.
Alrighty, thank you,
If
Andrew.
we're doing a marathon stream, I'll hop on. The dance
I
video.
I might. Depending on how viewer feedback goes and all that, viewer interaction, etc.
Just explain to them how bullish GameStop is and MicroStrategy and B. Riley. That's a favorite of yours.
Dex actually asked me to talk about B. Riley like forever ago, and I still haven't.
From a quick Google search, it says immediately, so that implies like at 12:01 a.m.
That's what I'm saying. I wonder when they're going to announce it.
Well, we know what they are. We just don't. You just need to know the time. But if it says immediately, the assumption or the presumption is.
I thought he was like weighing different kinds of tariffs.
No.
See how it all plays out.
Oh.
We have lost visual and audio, Fabio.
Sorry, it's because I'm hopping back and forth on the internet, so I'm seeing it's the auto tariffs.
Hey, your favorite guy? I'm seeing people posting stuff on Twitter.
My favorite guy. Who's my favorite guy?
Oh, he posted it himself. He posted it himself.
Well, who's my favorite guy?
Gary Stevenson. Here. I'm going to do this and I have to hop off. I will share my screen just for you guys.
Gary.
Oh, wait. Jake asks how the end of the Shkreli voice call went yesterday. Just to squeeze that in.
Oh. So it's pretty funny because I think I told you, he thought I was like a buy-side analyst. He's like, oh, it's more like buy-side guys on. I was like, I'm not a buy-side person. Oh. But I think this is like, I was just trying to throw pitches out. Basically what happened was I pitched buy now, pay later as an idea, and like everyone just commented on it, and so then I left. Not like I was mad or anything, but just like became like securitized burrito loans. But I enjoyed talking to Martin because I was pitching Applied Digital Short. And he was very, very, very interested in that one.
I forget, is Applied Digital too small for him though?
1.3 billion, 1.4 billion?
Yeah, I don't know where it is on his menu. Because for some, like, I was aware that, like, it's on that line of probably too small. But
No, it's tiny size. I mean, these quantum codes are smaller when
already.
Hold on. I just want to show you this. Fabio will be like, oh, this guy. Second I show him.
I come from East London, okay? My friend can't see their kids.
Oh, this fucker.
If it was as simple as going out and being an entrepreneur, I can bet you they would do it.
Yeah,
he's such a grifter. It's not even funny. When he bragged on that episode, he was just like, I actually make money from predicting the economy. And I'm like, you fucking piece of shit. You have a Patreon. That's how you make money. You just make Doomer whatever slop content.
No, he also sold
slop content. It's all
Oh,
slop
sure.
content.
No, I agree.
Doom porn.
Yeah, selling a book on how to be rich and then becoming rich from selling a book on how to be rich. Slop content. And then having the audacity to go the moment he went on a show like that and then said that he alone, like himself, just by himself, makes money from economic predictions.
No, he does. He
Oh,
predicts that. He's true though, because he predicts that people will buy his Patreon based on his talk. That is an economic prediction.
he's so dumb. He's so that irks me. People like that irk me. And what irks me too is that the other guy didn't have either the sharpness to immediately call him out, or was too polite to call him out. Because the guy he was debating, the supposed entrepreneur, right? He was like, he didn't have either the sharpness at the time, or it was too polite to call him out. Because anyone, and I mean anyone, who comes in and argues from authority like that, immediately charlatan. Every single time is a charlatan. No one who carries himself like that, by the way, would ever be someone who's like, oh, I make money from economic predictions. It's like, no. You're not Stanley Druckenmiller. I'm sorry. There's only one of him.
And none of us are him.
And none of us are him. Yeah, the guys. I would have immediately been like, oh yeah, okay, what predictions? Oh, you mean your Patreon? Do you have a Patreon? Oh, that's how you do it? Oh, okay. And you should see how much it costs. His Patreon? Oh yeah, he's making millions predicting the economy on his Patreon.
Behold, you guys, the greatest April Fool's Day news ever.
Dude,
The
April
greatest
Fools
two counts on
annoys
the
me
app.
on Twitter. It's just like going through a meme, just slop and going there.
Oh, but
Yeah.
Deloitte acquiring Kapunga. You gotta love the memes.
Deloitte.
Deloitte.
Yeah. Deloitte. And Kapunga. Like music?
I'm gonna hop off. I have a day job because I'm on Twitch like you.
Thanks for hopping on, Andrew.
Oh, of course.
I'm just on vacation. I'll be back to my...
You just said that's your office. We all know.
This is my new office.
Okay. I'll talk to you guys later.
Bye, Andrew.
Andrew?
Bye. Have a beautiful time.
All right. I should also head out here.
No, before you leave, Fabio, do you have anything you want to promote or shill onto the viewers in the off chance that, there's not overlap?
You can come follow me at Capital Mindset on YouTube, Twitter, Twitch. And yeah, that's where you'll find me. Thank you for having me, Bacon.
No, thanks for stopping by and in the middle of your vacation, no less. I'll see you around.
More than happy. I'll see you around, Bacon.
Yep. And on that note, everybody, do I want to embrace morbid curiosity just for Dex? I mean, Dex is a good person and doesn't ask for much. Let me set things up here on the fly because lol Lamau we'll be viewing things in real time here. Yeah, I'll do it because I actually have didn't view this one carefully. So let me see. Let me make sure that things are okay, or as okay as they can be. So the most recent big bit of news using good old SEC Edgar. besides Schedule 13s. Uh, change of ownership. Um, well, we have the notice that they're delaying their 10K. Alrighty, so let me do some reading besides the usual rigmarole. Uh, um, do 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 do. Net income available to common shareholders at the end of the calendar year last year expected between a range of 48 to 68 million dollars. We got our diluted estimate. Ba, 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 ba. Divestiture. Oh, so B. Riley is claiming that they got some monies from discontinued operations related to great American businesses. Net loss of continuing operations is expected to be that's a tighter range compared to the wide range of net income. That's great. That's great. Cash and cash equivalents. They're claiming. Jeez. When roughly like when that large of a chunk of your cash and cash equivalents is restricted cash, I think that's amusing. Um, yeah, yeah, about that. Um, so they're claiming that they have funds receivable of that much, decrease. You see, moments like these right now is why I know we've done this bit before on this channel, but like people doing actual like real life, real time due diligence, I firmly believe it doesn't make for great content. Like I'm not that imaginative or creative enough to or captivating enough to like entertain while doing this. It's a lot of like me muttering underneath my breath, talking to myself, or like trying to think. Decrease and increases approximately. Da, 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 da. Net loss. Okay, so we got our net loss here available to common shareholders. Blah, 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 blah. Related to our valuation. Oh, okay, so yeah, there's still obviously hold Freedom VCM that VIE under yeah, they still hold that. Oh, there we go. Estimated impairment charges of goodwill and intangible assets about 100 to 106 million. You'll love to see it. You'll love to see it. Yeah, for those that don't know or forgar, B Riley is just like it's a company that I had a bearish position on, and thankfully did all right for myself. Far better people did the vast majority of the heavy lifting. Also collaborated with the people that made appearances here. So, I thought that based off of the planning of things where things were at the time, there was money to be made. Thankfully, it worked. But I also thought that there was the case of what am I entitled to, because there is transaction costs if you wanted to put anything bearish on this company, and thankfully it worked out. But I thought that there were constraints And yeah, thankfully it worked out. But like for now, fair disclosure, I don't have any positions on B Riley. This is just like morbid curiosity at this point in time. Um, Kiwi Sam, yes. Now everybody leaves. Everybody go away. I joke. Uh, so yeah, there you go, Dex. It. All right. So I know like fairness to Dex's original request. The timeline was he wanted me to look at their quarterly stuff, and it was I don't think their June 30 of last year 10Q was particularly interesting, but it was the September 30th 10Q that looked pretty gnarly. um but yeah. This company, man, this company. I thought they spun out one of their segments and IPO'd it, or they're in the process of doing that, um, which I find interesting. But you know, um, time will tell. I mean, like I think I think it's great from a real time learning perspective. See market participants and executives, because want to say Brookfield is around here. Like one of I thought I saw one of the filings mentioned how like their revolving credit facility or their credit facility with Nomura has basically been swapped out onto Brookfield. Um, the thing is like, while I don't have any money, so I don't have any skin in the game. On this, so my opinion shouldn't really count for anything. Um, I would say though, like if I were to put my money one way or the other, uh, I don't know if I'd be very comfortable holding, common stock like on this company, because fundamentally, like you the shareholder, what are you entitled to? Like, yes, you get to vote, hooray! Uh, but we're talking, you have a residual claim, and obviously with the arrangements of things, debt holders uh, have higher priority, and this company is quite levered. So that, and also what is uh, again, if I'm recalling correctly, what is Brookfield's standard modus operandi? Um, definitely not one that inspires confidence. Bye, Norman. Thank you for stopping by. Want to thank everybody that has decided to swing on over. Appreciate it. Means a lot. Like, yeah, everybody can see the view count, the number being like, oh, it's not impressive, but in fact, anyone shows up and sticks around, um, it's a big deal to me. Pleasantly surprising for me. Um, but yeah. Brookfield's standard method of operation is buy things pennies on the dollar, and if I, the everyday person in this case, think that I'm going to be able to get any cool upside before Brookfield somehow, that's either I've navigated that the debt profile very well, or I'm just like sheer luck, like have embraced incredible luck, which is not something I'd rather do. Um, Thank you, Dex. That's great. That's great. Happy. So yeah, B Riley. where is their share price right now these days? Because they did have a jump, not that. Oh, good lord, back below $4 a share, eh? Because like year to date wise, they did cross above $5 a share, not crazy long ago. Yeah, back in like end of Feb of this year. Yeah, end of February, and then just keeps grinding down. Like I am not playing in it either, but some of the really bad or questionable quantum computing companies, at least they have some quote unquote fight in them. um, I don't know how they've been doing either. I don't claim to be great at this. Because even if I were correct and have been correct, there's there would definitely be a recency bias component, and I don't think the sample size is large enough to concretely say, "Oh, I am amazing." Um, 'Cause I think that's just like the long and short of it. I don't think. Actually, I wonder, should I make a poll? Yeah, let's do it. Let's do it. Let's have some fun. Let's see if I can properly YouTube here. Um, yeah, let's do this. Yeah, let's have some fun. Here. And if I can type properly. And I'm limited on the choices for the poll. If you think it's beyond, feel free to comment. I don't think it's that big a deal. Yeah. So for those that have me on second screen or are just like listening, question is, how long does it take to say you are good at actively investing? By actively investing, I mean like you are the decision maker. You are not like just buying an index or a selection of like funds, whatever funds they may be, that are you know either actively making some sort of decision or so on and so forth. Like you yourself are actually like managing your portfolio, picking your selection, and it could be anything. It could be idiosyncratic fundamentals. It could be like trend following or some sort of technicals. It could be uh, some sort of quant approach. Just curious. Just curious. Um, hey, people actually voted. That's wonderful. Love to see it. Um, Basic statistics. N must be greater than this arbitrary number. I joke. I half joke. That's it's not arbitrary if you go through the actual equations. Um, it makes sense. It's at least understandable. An argument can be made. I like it. I wonder. Hmm, do I want to double back onto anything that I made on my cringeworthy Google sheet. Because I think in my sleepiness last night of like editing the April Fool's Day Google sheet, I fucked fucked up the whack part. Like I'm pretty confident I did. But like the good thing is, in my defense, when I plan these things out, I like to try and show like the textbook formula, but also like explain the formula in a way that people can understand more readily, more easily. Um, so even if I screwed things up, I at least did so in a way that an effort was made to yeah, because something seems off. Like if the beta increased, well, hmm, new whack. Like it would bump up the return profile of your equity, but like wouldn't it also make the cost of your equity go lower then? Assuming all else being equal, which is obviously a silly assumption to make. Like you take on a risky project, I'm pretty sure any sort of like you know banker or the debt market would treat you accordingly. I don't know, man. Oh, you had first vote. Thank you, Dex. Thank you. I actually got another vote. 5 to 10. Yeah, so assuming like 5 to 10, which very, very small sample size, but if that actually holds, yeah, it is way too early to say if I'm any good at this. Um, and then again, like the this poll is poorly constructed on my end because like what are we defining as good? There's definitely like subcategories. Um, Portfolio management, I think, is a very big deal that probably gets either overlooked or under considered. Because like this isn't me being like, "Ha ha, I am smart, I am great." Um, it's more so like I know, like with the benefit of hindsight, last year if you ran very concentrated, some of the cool names like in Nvidia, you probably were quite happy with the results. But like year to date, bro, is which I think is silly and not fair. But if you want very concentrated Nvidia or still held, uh, you're probably not very happy with the erosion um, of some of those returns. Uh, but again, like this isn't me, like um, jumping up and for joy, being like, "Aha, you Nvidia clowns!" Like, no, 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 that's not this, that's not me. I don't know enough. Like, Nvidia is really cool and really powerful for legitimate reasons. Like this isn't like vaporware scamco territory. It's a real company, you with real meaningful, customers and employees and etc. Um, so like whatever the stock price is, I just know that I don't know enough. Uh, and sometimes that's okay. Knowing that you're the sucker at the table is fine if you don't sit at that table. Uh, but yeah. This this is weird. I legitimately thought that I was going to have to like yap with the original stuff for 2 hours plus. We haven't even hit the 2 hour mark. It's weird. I don't know. Like, I mean, like fairness to the classes that I took and have like flagrantly stolen the information from and have provided. Uh, more examples were done, and like people ask questions. Like this live stream is not enough to replace a legitimate like finance 101 course by any means, um, because like you would actually have hopefully an experienced and hopefully a receptive and attentive professor that is helpful. I'm not really your teacher or anybody's teacher, but what I am is a person who has and produces scuff on a low budget and low tight budget, and tries to break things down and explains things that I think are hopefully interesting in a nerdy way and of questionable value. So we got that going. Um, hmm. Yeah, April Fools. I forget. Market's closed. Um, Let me take a look at something. Oh, the S&P actually closed positive on the day. That's good. Let me see how badly I did with my port on the day, because the one day is all that matters, not year to date. Oh, I actually closed a little green. That's funny. I didn't think that was going to happen. The hell happened? What madness? What hedge funds? The hedge funds. What the market makers? They're they're pushing things so that way I made it green on the day. It's weird. Just weird. Um. Hmm. Oh, holy crap! I may actually. Yeah, we'll see. Still plenty of year left. Plenty o year left. Um. Do. I might as well end the poll. 5 votes. It's far more than what I originally expected. So, majority of people would say 5 to 10 years would be long enough to evaluate if you're any good at this. I think I could see some arguments. Because like the way how some people would structure that would be economic cycles, which I think there's legitimate arguments for that. But also I think there are some legitimate counters. Because like, and I don't even mean like, oh, I'm not macro guy, because I'm not. It's more so economic cycle. Like each economic cycle may have its own catalyst and its own how things are expressed or where funds flow, or how things fundamentally perform with each detail, has its own wrinkles, has its own details. uh, yeah, because like I got a bad feeling that these days we still talk past each other. If I say or anyone says the word recession, like what do some people think? um, do some people think, oh, textbook definition of like, what was it, 2 quarters of you know GDP growth, or like lack thereof, or what have you? Or is it like people think, oh, 2008 if you're in the US or maybe in Europe, or they think '07, because if you were a real estate person in the US, that was like you're, oh crap, this is rough. um and even then, like, not every recession necessarily like plays itself out like that. um and your inputs, because like if we went with the textbook definition of like some sort of GDP contraction for a time frame, um, I don't know. Like plenty of things could cause a country's GDP to contract for something, and the contraction doesn't even necessarily need to be that long necessarily. Um, yeah, so I'm on the fence. I'm not sure like how long it takes to evaluate if you're any good at this. Um, and then of course, what are we talking? Like, oh, you need to beat this benchmark, or is it more of don't blow up your account? That's a pretty low, well, relatively low bar, hopefully. But you things I think about, things I think about, crudely think about. Just rambling here at this point. Streamer yapping. Uh, but there was another point though that I wanted hit. Um, hmm, 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 hmm. Trying a blank though. Yeah, maybe it wasn't important after all. The sleepiness fogs up the mind. Um, well, don't think I have anything much else to go off of. Anyone have any requests? Last minute requests? Like we got roughly 3 minutes left until close. So if you're here, feel free to say. Yeah, I think that's relatively fair as well. Um, Depends on the strategy, definitely, definitely. Because like when people say, for example, I'm a value investor, uh, that's such a large unhelpful tent that it almost doesn't mean anything. And fairness to the technical analysis people, which again, I full fair disclosure, I'm on the fence with or of. Uh, like I respect the efforts that people would put into having that sort of system and framework and the discipline to go with that methodology. But what I would say though is like if you're a technical person, um, your benchmark maybe is a little bit more tricky to navigate or have. I'm aware that like trend following CTAs, there's multiple of them, and maybe sometimes getting data on that is a little bit more tricky. So I respect the challenge of trying to evaluate things. Yep, yeah, market neutral. That one's fun. That one's fun. Um, yeah, and then there's people also that would be like, oh yeah, Sharp ratio or some sort of like other, like Sortino or well, I'd probably butcher the pronunciation on that one. Mar ratio. Go with that. Uh, yeah, I'm no quant. Um, my statistics like it ebbs and flows, but it tends to definitely not be not be top of the crop. Not be the cream of the crop. Not be the greatest. Um, but I certainly respect it. My p values. Make sure that the null hypothesis is set up properly. Otherwise, you screw everything up. Don't want to screw it up. Um, Yeah, I think we're all tapped out here. Happy April Fool's Day. Thankfully, closing remarks from me, I guess, is thank you to all the guests that showed up, or well, Andrew. This is Andrew and myself's side project. So thank you to the big man as well as all the others that I like to collaborate with. It was nice they didn't have to. I was surprised that it happened. Yeah, I'll see people around. Buy decks. Oh, don't you don't have to sad emote. You know that I'm around. I'm not like impossible to reach. Um, yeah, link in the description if you wanted to. Um, yeah, yeah. Oh, hey, look at that! Just when I was going to end it.
Oh, you're ending it?
No. You're fine. You're fine. I can keep going.
I only got like 10 minutes, and then we got Karata.
I,
Yeah, the phone app sucks balls. It crashed on me.
No, that sucks.
It sucks too because like the audio sounds like shit, and then you can't see comments on the phone.
Oh, really? Oh, that's
Well, you have to
that's
push like a side. It doesn't just pop up comments. You have to like pull them.
Yeah, that's a pain in the ass, son. A needless one.
That mother trucker with his Mr. Cooper. No. I'll have the last laugh now because it's a one pony race, right?
Yeah,
maybe the arbitrage is to sell Cooper and buy Rocket now after Rocket got splunked on the news. So
oh, it's funny though. Like, I haven't done as much digging on the deal, but like, how bad is the dilution we're looking at with rocket companies?
I don't know.
Yeah, like there's also Redfin. Like, assuming all those.
I sent you guys that. Yeah, so
Yeah.
they did all stock for both transactions.
Mm-hmm.
So I was going to bring this up on the group chat, but like, do you notice? Like, I'm not really surprised. A lot of these M&A activities is dilution activity.
Yeah,
but if you're management and you have a not great outlook on the economy, right? And you're looking at acquisitions, it's like, well, if you don't think your stock's going to perform well in the next year or two due to the market, then why would you use debt or cash? Yeah, dilute the hell out of yourself because it's already bad news for everyone.
Yeah, no, that is true.
When times are good, you wouldn't want to do that because then you're costing yourself money diluting. If the stock is, expected to raise,
yeah,
dilution sucks for you if you're because management has their own shares. But yeah, I guess we'll see. But that James Hardy deal, man, I wish I could put odds on it. I don't think it's going to go through, but that deal is terrible. If it doesn't go through, I think the CEO is going to get canned, and the board should get canned if that doesn't go through because that's a pretty egregious deal. The dilution of those people, the people that own James Hardy are. I don't know how you make sense of that transaction, but
yeah, that's like our last live stream together, not this one, obviously on your channel. I picked like M&A and possibly IPOs almost on a whim. It seems like the timing on things in hindsight maybe could have been on IPOs also.
no,
because good lord, what the hell is happening? Like some of these companies.
I'm curious tonight. I might go look. I mean, I really don't care that much.
Yeah.
I'm not doing a live.
Mhm.
Well, I could do a live stream tonight, maybe, but
Yeah, I can hop on if you wanted.
I would just be curious. The only thing I'd want to know is what percentage of I don't even want to look into this because I don't want to buy it, but like
Yeah.
the structure of Newsmax, because I'm assuming it's going to be some weird ass structure where like 5 or 10% of the float is tradable right now, which would explain if a lot of the shareholders are in lockups or something, right?
Yeah.
Maybe they have warrants and they can't execute them for 6 months or a year. So holy God. So it might be like people, oh, I wish I got in. Well, maybe you literally couldn't have got in. I guess who knows? So
yeah.
But I think you can start shorting it after like 3 or 4 days. So
Yep. Yeah. It's sure is interesting times. because
Yeah, broadcast TV beating AI.
yeah,
What are the
friggin',
days?
it's a head scratcher. Like,
Do you know what their revenue was last year?
no, I don't.
It's like 150 million,
Wait, what?
and they lost money. So this is not a 10 billion or 20 billion dollar market cap company, whatever the fuck it keeps going to.
The hell is going on?
I don't know. Like wild times. I maybe it's just the flavor of the month and then such a short float, but interesting.
Yeah,
See if it gets to 500.
because if you told me like between Newsmax or CoreWeave, who would have the crazy percentage day, like I would have thought it would have been CoreWeave.
I mean, a lot of this probably just depends on how these things get structured.
Yeah.
You have to read through exactly. I don't think IPOs are so messy like SPACs. These are both IPOs, right?
I believe so. Yeah.
Are we sure? Because Newsmax was a $10 issuance. Are we sure that was that a
Oh,
SPAC?
yeah, that is a fair point.
Because that's what a SPAC comes out at.
Yeah. Yeah.
I haven't looked. I don't even know what CoreWeave does.
Yeah. Right now, like brain fog because sleep deprived. But
Did Johnson and Johnson have earnings?
I don't know. Apparently, like
they don't have earnings on. Well, it's Tuesday actually. So
yeah, because I think they got punished from some sort of like talcum powder news.
They did earnings in January. Oh
yeah, it's the talcum news.
They tried to get rid of that talcum powder, and all the cases like, yeah, it's still on you guys, even if you split off, divested from baby powder.
Yeah. The core original J&J, not the spin.
Oh, did he have a pharma announcement? Oh, wait, that might be it. Remember he was talking about doing a pharma tariff?
Oh, yeah, that's right. Yeah, that is. Yeah, and you would think J&J, as big and established as they are, they probably have the diversified network.
I'd be worried if I was a CHD person this year. They're going to get wrecked on that, I think.
Oh, no.
They have a lot of pharma exposure.
A lot of exposure.
Lot more than anyone would ever want.
Yeah.
They have like all the big pharma companies in SCHD now. So, man, it's going to be a rough year for them. But buying opportunity if you're long term.
Yeah.
Okay. I don't know. I guess if you're going to go live tonight, you got to do Newsmax. If I even feel like looking at it. Okay.
Yeah, but if not tonight, then tomorrow. Or
Russ Russ from Dapper Dividends. He was kind of interested in Huntington Ingalls, which is funny, but because he was a Navy guy.
Huntington Ingalls is one where like I don't feel comfortable like waving a flag around with that one, just because the management's so ugly. And like, yeah.
He asked me what that even means because I said that like management sucks, and I was like, I wasn't ready for that. But then I'm like, okay, how do I describe this to someone who doesn't really follow them? I'm like, why does management suck? It's like, I should actually explain. I'm like, so I my brain went to, they have weird excuses for things in the calls.
Mm-hmm. Yep.
Like they have the excuses that they were giving for why their, revenue and their margins went down were just like, they were like, labor issues. It's like, okay, what are you doing about it? Like there was no solutions to anything. They said that was a problem.
Yeah.
So
it's bad external communication, and then also your ability to operate.
I don't know. It's like, okay, you're having trouble attracting new talent. Are you?
Mm-hmm.
Have you gone to like the local community colleges and maybe tried to create a program working with them? That's a big push in the Northeast. I don't know about other parts of the country, but a lot of companies now will go to the community colleges to create a curriculum, and then they'll get them through training to do like that type of technical work, whatever it is, working for the fabs or utilities and stuff. And then you help. It's kind of like the students share some of the costs, the counties share a cost in community colleges, and sort of so community colleges are great for that because everyone shares like the cost of a community college education. That's why it's so cheap. Because you have like I've seen when I was at a community college, Yeah, all the government entities you're paying, everyone's kind of chipping in. That's why it's like $3,000 a friggin' year or something.
Oh yeah.
But, so I don't know. I don't know if they need to work for the community college or just give out bonuses. I mean, give
Yeah,
out bonuses, but if they're in a union setting, that's a tricky debate,
Mhm.
right? Because
Yeah.
if you're going to do bonuses and you're with a union, it's going to be permanent. It's not a 1 or 2 year. You're going to make it probably a permanent issue.
Yeah.
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 Yeah, tricky. Like, because if you're like, oh, we're gonna give $10,000 bonuses, but you only want to do it for a few years just to get numbers up. It's like, well, if it's in a union, you don't have to put it in the union contract. You could create just like a memorandum,
Mhm.
like an MOU. Unions have that where it's like agreements outside of the contract, like temporary, but things don't usually stay temporary. I don't know.
Yeah.
But I was waiting for someone to call, like, what was the worst comment from when he interviewed me? The worst comment was someone said that I'm a beginner at options because I was talking about Delta. And then they said I should look at, and then they gave their modeling theory of like the 0.5% theory of options, some bullshit. So I looked that up, and it's the theory. He said why I'm such a noob because I looked at Delta, but he's so much smarter than me because he thinks of the 1% option theory was like you should limit option exposure to like 1% of your portfolio. I'm like, how does that theory make you better at this than me just talking about the fucking Greek letters? People are weird. That's
Yeah, they definitely are.
If someone doesn't like you, they're just gonna pick apart some random thing you say. So it's fine.
Yeah.
It wasn't even it was a weird criticism, but anyways, I gotta bring the girls to karate soon.
Yeah. Thanks for hopping on, Dan. I'll hear from you soon, I imagine, for a future collab.
Basically, how things go is I get off work, I get annoyed, and then I just decide 3 things to talk about, and then I tell Bacon to find a 4th for me. Then I have a bourbon, and then finally I remember I should do a live at like 10, 11 at night. And then I hope and pray that Gil doesn't come on and start screaming at me, which never happens. And then I have to tell Gil to fuck off. But I don't want to demonetize you by swearing too much.
So. You're fine. You're fine. This is a side project.
Okay. YouTube doesn't care about swearing unless it's in the first minute. So basically, they'll scan your first minute.
Hooray.
So you don't start out being a potty mouth, basically.
Oh, yeah.
And you're fine. Oh, at least we're holding on with Huntington Ingalls. So,
oh yeah.
What are we at? Like a 20%? What's your cost basis?
Oh, I forgot. Like I know it's green and it's up like a little bit above 5%.
So 11%.
Oh no, I was wrong. Oh, thanks to today, derp. Yeah. Divided by cost basis of a little bit above 190 a share.
Okay.
Yeah. So still green. It's not the culprit for bad performance of the year.
No, I think this is not the year to take big risks.
No, I don't think so either.
Take some calculated risks on stuff like this. Falls in line.
Yeah.
I don't know. Go after companies that get cut in half that just kind of got sympathy dropped with everyone else around them, like Decker.
Yeah.
You just hope for the best. So. Ooh, 113. Okay. If that gets up to like 130 again, I'll be very happy. Probably bail on it, but
Aeon, I'm down on Aeon right now. That's great because I have flexibility there.
What, 79? Yeah, I wouldn't. If it got back to 70, it'd be a discussion again. I wish I'd bought more.
Yeah,
I did make a buy at 70, but I didn't go crazy. So
I didn't have any, so I figured I'd just like limp in. So maybe it gets punished some more. That'd be cool for me, at least.
Wonder what Fabio's going to buy with that coupe. I'm sure he's going to buy something similar again. More financials.
Yeah. Yeah, he definitely has hinted some things.
Those are tough for me. Those companies.
Yeah.
It's like, oh,
No.
Strongman just posted a video that fired.
Yeah. It's long story short, it's April Fool's Day prank.
Oh,
Yeah, like he made it very convincing though. Like I will say, like if
I
didn't
wow,
know,
he got me for a second. I was like,
Yeah.
oh my god, I gotta message him.
yeah, Yeah.
Did you on Twitter? Did you see he changed his profile picture to that woman that he likes to mess with?
yes, I saw it. I felt
He keeps dude. Like 3 times I'm scrolling and I don't look at I see the picture and then I see him say like "fuck off," and I'm like, oh my god, she's pissed at somebody, and then I see
Yeah.
it says Strongman.
Yeah,
Fuck it, dude, it's hilarious. He's hilarious.
he is. He's a hoot.
Yeah, I don't know those people that go after him. I'm like, dude, you're picking the wrong fight. Like he's Chris knows no boundaries. Like, it's weird that you're gonna fight with that guy, but
Yeah.
but I think we're done with that. Are you in Strongman's Discord?
I am, but I never really like check up
Do you-
consistently.
I think we're through the Psycho Andre phase. That TQQ guy.
Oh yeah.
You got like nobody. There were some people like, why did you guys ban him? Like, first, like he was saying atrocious things in the Discord, but then he was also saying even worse things to me and Strongman directly. He was directly DMing both of us and saying freaking vile, like gross things to us. Like,
Ugh.
I put him in timeout and then I'd get bombarded. And that dude's like he just needs to go away.
Yeah.
Like psychopath doesn't even start with it. Like, but I hope he's gone for good. But yeah, he came back in like 15 times.
Jeez.
So I had to keep me and Chris had to he like for 5 days straight, he just kept coming in, even though we're like, just move on, dude. Just move on. Like go somewhere else. We like
the world's big enough and like there's still low cost enough hobbies that you could do literally anything else. I don't get it.
Well, like and I try and say in there, I'm like, I know it's a hard disc quiz. I'm like, you can attack people's investments, but don't directly attack people because that's when it goes.
Yeah.
That's when it goes downhill real fast.
Mm-hmm.
Like you can attack, like we can make fun of each other's investments all day. It's not really going to hurt people's feelings unless it's like Tesla people. But like when you start then going after people, right, directly, it's like that never ends well. So I try and keep that down. And he was like attacking people personally. Mm-hmm. It got really, and it gets nasty. So I tried to just attack TQQ, which is fucking embarrassment.
Raised question, maybe IP address ban. I don't know enough.
Like, Dex might be smarter about Discord than me.
Yeah, my mod powers are really, really lacking in capital mindsets. I don't know a lot of the.
I'm sure there was a way. I don't know. I'm afraid if I try and mess with a Discord, I'm gonna break it. If I change the settings, because a lot of it has repercussions that you don't even know until you change it, and then it's like,
oh yeah,
all of a sudden 20% of people can't see shit. It's like, what the hell? But yeah, that guy, like he may have had a point with his inflows idea. He may have had a point, but his application of that theory was just stupid. Like there could be something behind saying inflows of money is the defining factor in investing, but then it's like his application of buying a triple leverage a daily triple leveraged QQQ fund that doesn't even own, it just has credit swaps. That's all you're buying. You're buying a basket of credit swaps. I was like, and then he's down like 35% this year, and we're like, we don't even have to like debate you. We can look at a chart to see you're wrong, that you're getting obliterated on any sort of downturn. And then he just started attacking us personally. But the fun of being, I didn't even ask to be mods of all these things. People just, I'm not doing modding of anything else. If anyone asks me, I'm gonna start retiring the shit. But I gotta get annoyed because I'm like, I mean, I'm not even like you. Oh, you can talk about anything. I'm like, I'm not going to let people discuss long-term investing in TQQQ. Like that's utter nonsense. I'm like,
Yeah.
no, this is not free speech.
It's
Like
it's not.
as somebody that's been in the markets for 25 years, like it's like no,
That's
denied.
not the right product. It's definitely not the right product.
I'm gonna save people from themselves.
It's yeah.
Whatever. All right, time for me to go.
All right. Thanks for hopping on again,
See you
Dan.
later.
Yep. See you later.
How do we get out of here? Okay.
Yeah. So, on that note, um, thank you all for stopping by. Hope you have a great April Fools, cause I'm sleepy. I will see people around. Don't know when the next one will be, because again, side project. We all have lives. Andrew's life certainly has gotten a lot more busy as of late. But appreciate all y'all for stopping by, and see you on the next one. I